My name is Cameratta, and I work at a North Star Resource Group. And I was asked to just come here and kind of go through some of the basics of financial planning, a little bit while you're in training, and then kind of as you progress through your career in the early onset. So I have some of the basics and some of the things I was going to go through here. The main things I was going to touch on today is really going through the foundational pieces, the things to really consider and kind of get a good grasp on as you go through residency, fellowship, and then as you really go out into practice and, really touch on those things once your income goes up and kind of some of the more fun things to think about. But really what I'm going to touch on today is a little bit of the debt management, kind of the balancing act, savings versus paying off debt. Building up some emergency reserves. I'll touch briefly on the risk management side, but I'll kind of run through a short list on that. And then really what to consider after you go through the foundational pieces and really kind of building the savings, starting to invest, and kind of really getting the retirement planning going. So where I'd like to start is really the debt management. The first thing I really go through when I sit down with some of my clients, especially during training, everyone's main question is, hey, if I have a little extra money, I got all this debt, how do I balance it? Savings versus paying off debt, how aggressive should I be? So there's really two different ways to look at debt. The first one is really the emotional side of it. That's really coming from you. If this stuff comes up or keeps you up at night and it's something along those lines, you just can't have it there, forget kind of what I'm going to say, go ahead and pay it off. If it's something that you just really can't handle, there's nothing wrong with paying off that debt. But on a financial side, the first thing I really do when I sit down with my clients is line up all of your debts. And as a financial advisor, how we look at it is really looking at what is the interest rate associated with that debt. And then we compare it or kind of correlate to what could we get by investing otherwise, or kind of what is the rate of return we can look for over a 10 to 15 year period of time, and could we possibly do something more efficient with that savings to kind of put you in a better place over that time and obtain a little bit of an opportunity cost. So really how we look at debt based on the interest rates, good debts really fall between 0 and 5%. So right now, the main one that really falls in that area are mortgages. If you have a home, you can kind of get those mortgages at roughly around 3-4%. Then if you work at a hospital, it might be one of your main tax deductions, as you can deduct that interest up to $1 million of a mortgage. So that type of debt at 3-4% after your tax deduction is a really good debt. It's something that after you take the deduction, you're actually at a lower interest rate than historical rate of inflation. 5 to 8%, a lot of gray area. That's really where the conversation comes with between you and your advisor. What are your goals? What are you looking to do over the next few years? Kind of what are your main objectives? Then 8 and above, most credit cards, some private student loans, maybe like some relocation loans. 8 and above, really try to aggressively pay those down. There's really no strong argument that you can make otherwise to say, hey, maybe don't pay down that debt, invest the money otherwise, because 8% is really hard to vastly outproduce over a long period of time. The main place that we look at and when we come up with these rules of thumb is really what's called the Dalbar study. It's DALBAR, if you want to Google it. What this thing really studies, it studies multiple things, but the main one is it does a time looping analysis basically from our market from inception to today, using kind of like a 10 to 15 year period time frame of having your money invested. And what this really says is we've never returned less than roughly about 7.5 to 8.5% in the market. So when we look at the mortgages and the good debts, we kind of say, hey, maybe we pay the minimums on there, take your tax break, invest the same money that you would have sent there otherwise in, a very liquid account that also is getting a nice rate of return. But over a 10 to 15 year period, could we make more money for you or kind of get some opportunity cost on your savings? Now, the main question that I was getting and was asked to talk about, and I'm sure in this room it's one of the main things that you guys really want to learn about, as depressing as it is, I guess, but is really the student loan options. It feels like every day someone's coming out with a new program for you. What makes sense for you versus what makes sense for your colleagues. And sometimes this stuff is just really hard to navigate through when there's not a lot of information to go off of. So currently, there's really about 4 different ways to go about paying off debt. Okay? The first one I'm going to touch on is really offered to you during training. You know, it's not really a way to pay off debt, but it's an option for you. It's called forbearance. Essentially, it's a declaration of, hey, based on my income, my expenses, I can't really afford to begin paying off this amount of debt or making these monthly payments. So during forbearance, essentially you can look at your loans in two different buckets, okay? You got your subsidized and your unsubsidized debt. During this period, you're not making any payments, and what's happening is essentially there's a hole that is poked into each of these buckets. Interest accrues into a little smaller bucket, and then once you enter practice or go into a repayment plan, that interest will then capitalize on top of your balance, and that's basically the new balance that you now have to pay, okay? Once you're in practice, standard repayment is a very common one for people to go through. You know, it's something that you can go on to like a 5, 10, 15, 20, extended 30-year repayment plan. You go to your lender, they run a calculation based off the interest rate, the size of the debt, and say you want to pay it off in 20 years. They'll give you a minimum payment that you'll have to make over a 20-year span, and they say as long as you keep making this payment, you know, at the end of that 20 years, your loans will be gone. The one that I'll probably get the most questions on, and I do get the most questions on when I sit down with residents and fellows, is really these income contingent programs. You know, it feels like there's a million of them out there today, but you know, the main ones that I really talk about are the income-based repayment, the pay-as-you-earn, the repay. You know, these are programs that came out starting in 2007. The government came out with them basically to say, hey, we understand your income's a little bit lower. We're going to run a calculation based on your income, your debt size, and give you a number that we think you can afford. So during this period, the nice thing is if you do have some subsidized loans, you know, the first 3 years that you're in any of these programs, you do get the forgiveness on the subsidized accrual or the interest that accrues on your subsidized debt. But it just gives you a good way to do something with your loans, have a plan, and also make some payments towards that. Which one makes sense for you? You really want to sit down with someone that kind of knows these programs cold, you know, someone that knows your situation. You can kind of tell them, and then they can kind of run through all the programs, the pros and cons to each, and then really get you into a program that makes sense for you. You know, the main thing and the really attractive side that I've seen people kind of gravitating towards with these programs is the, you know, taking advantage of this public service loan forgiveness. I'm assuming by now most of you in the room are probably pretty familiar with that. But what it says is if you are in one of these income contingent programs, so income-based repayment, pay-as-you-earn, and you make 10 years of qualifying payments in this program, plus you have your loans consolidated through the direct loans. That's a really big important one. I sit down with a lot of people. That one kind of flows under the radar. But if you're consolidated through the direct loans, you're in this program, and you're at a nonprofit or a 501c3 institution, if you make 10 years of qualifying payments, at the end of the 10 years, the government says that your loans will be forgiven tax-free. But if you're in one of these programs during training, there's a few things really just to consider. Make sure there is a form out there on the government website. You know, make sure to get that signed every year, because none of us really know how this is going to work, but I believe it's going to be an audit. You know, I think the government's going to come to you and say, hey, prove to us that you've made these payments. There's a form out there that just gets signed by your coordinator. You know, it says I work at a nonprofit, I've been making these payments, and it's just something to kind of have as a log when they come back to you to say, hey, I've been making these payments, now it's time for the forgiveness to happen. The last one, you know, if you are sitting here and you're saying, that's not me, I'm going to end up in a private practice, that's kind of my route, and you don't want to do the standard repayments, you know, because with interest rates really high right at the moment, there are programs out there for physicians, especially in multitude of different private banks that are actually willing to buy out your debt from the government and give you a lower interest rate associated with it. So there's a few of them out there. The big ones that I hear always thrown around are DRB or Devon Rowe Bank, SoFi. I'm sure they probably send you a bunch of emails, maybe some letters in the mail. But what these banks do is they buy out your loans from the government. Now they are privatized, and now you have options. You can go to fixed, to variable, and depending on a few different factors based on you and your situation, you can vastly lower the interest rate on top of you know, making sure those payments go down for you. But those are kind of the options in terms of paying off the debt. just remember, if you are going to go through the refinancing process and you want to say, hey, I want to be in a private practice, just understand once they buy your loans from the government will never buy your loans back. So after a year of private practice, you decide, hey, I want to go back into academics. Understand a lot of the income contingent programs kind of fall out because the banks now own your loans. There's one thing the government's willing to do, it's willing to sell debt, not really willing to buy back your debt. So just make sure, and a lot of people that go through private practice, maybe spend half a year, make sure it's something for you, and that's something you really want to do before going through that process, or just speak with someone you trust and knows these programs. The other second foundational piece, the first rule of thumb with training, obviously with the incomes and the lower incomes, just try to survive. The first goal is, try to build up at least 3 to 6 months of emergency reserves in cash, checking, savings, money market accounts, just something very liquid to you that is not associated with risk, okay? This is basically protection just in case something happens or an unforeseen situation happens in your life. You have cash on hand that's in a safe place and you can get it very quickly. As I mentioned, with the incomes being a little bit lower during training, just try to survive. The first thing I always tell my clients in training is basically set up a goal, okay? Even if it's $50 a month. Automation and savings is really habit forming, and based on training, when the number's not high, it's more just about doing something and getting in that habit forming process. Because then once the income goes up, you're already used to the habit and seeing money being automated, that number will increase for you. Another thing to also think about keeping in the bank account is really short-term goals. If you see yourself coming up on a big expense over 1 or 2 years, such as home down payments, I don't know too many people that have the stomach to kind of watch their down payment fluctuate with the market. So short-term needs are good to kind of keep in cash and very safe investments or very safe places that you can get to very quickly. The third kind of foundational piece is really the risk management. As I said, I'll kind of breeze through this really quick. So, some of the risk management, that's kind of the third piece of the foundation that you really want to address earlier rather than later, is really get the disability insurance. The main thing with that, protect you. You're the one here. You've been going through med school, residency, all this training to obtain that higher income and that lifestyle that you want to have. So make sure to get something that has a good definition to protect you. Now, if you have a family or you got married and your life is expanding, possibly buying homes or just kind of you see the lifestyle expanding, have some kids, pick up some life insurance. Make sure to have some benefit that if you're the breadwinner of your family or just takes a portion of your income to kind of sustain that lifestyle, make sure that if you happen to pass away, that you are not leaving your family with incredible amounts of debt or just a lifestyle they can't afford. Make sure you have enough on there just to make sure that they can maintain their lifestyle without any stress or worrying about expenses. The other three, auto insurance, obviously that's a very common one. Basically most states, it's by law, you gotta have it. Renters, homeowners, make sure to understand the liability limits on that. And then just a very simple asset protection rule up front. It's just a simple umbrella policy. The disability insurance, as I said, feel free to kind of take a peek, but David's going to touch on this. Really what it comes down to is really the definition that's associated with your policy, okay? The true own occupation, I'm sure you've heard a little bit about that versus the any occupation. Just make sure to go with a company that has a good definition. Go to someone that can shop it out. Make sure to understand the features because honestly, insurance is not fun to buy. No one likes paying for it. But I always say go to someone that can shop this stuff out for you because there's 5 companies out there now. MetLife actually just got out. But Emeritus, Guardian, Mass Mutual, Principal, and Standard, all great companies, just all different. Okay? So make sure to understand the features because if you understand or can grasp onto one thing that you find some value in, it makes it a little bit easier to pay that monthly cost or annual cost there. Same thing with life insurance. I'll kind of touch on this briefly. There's differences between term insurance. While you're on a budget, if you do have a family, term insurance is a good option. Keep that cost of the insurance as low as possible with as great amount of benefit as you can. With those policies, make sure that you have a convertibility feature on there in case you want to move up to the permanent level in the future for different things such as estate planning, if you have a practice buy sell, retirement planning, variable different things. But the convertibility feature allows you to kind of lock in your health rating so that if anything happens over that term, that you're still able to convert up there with no medical questions asked. So I'll leave that up there for a second. The last risk management, the auto, the homeowner's umbrella, it's pretty common in our world. But the one that kind of slips by people a little bit is this umbrella insurance. What the umbrella insurance really does is essentially puts, exactly how it sounds, an umbrella or basically a policy that has a benefit that in case you get sued due to a car accident or someone gets overserved at your house and they drive home and then they come back to you, because they got in an accident, and say they try to sue you, the umbrella policy a lot of times acts as if basically chum in the water for lawyers, to say, hey, they're a physician, they just came out of training, there's a lot of debt. We might just be better off, settling with an insurance company on that. The nice thing about these is they're very cheap. Go to your local provider, State Farm, Geico, your property and casualty, ask them about it. Usually the discount that you get both on your homeowners and your auto is something that can really, or basically is a net zero on the premium for the umbrella. But it's a good, simple way to kind of protect your assets up front, and those simple lawsuits, an umbrella policy is a good place to start. The main question I get, a lot is when people ask me, they find out I'm a financial advisor, is, how much do I need to save for retirement? There is a rule of thumb, and the main people I find achieving financial independence, I'm going to use this word financial independence instead of retirement, is essentially financial independence is I've accumulated enough assets based on, years of saving to say, hey, anytime I don't want to work, I can cut off my income stream and really tap into my assets and not see a drop in standard of living, okay? Now, if you want to continue working, that's great. You can continue to work for the joy of being in medicine, but you are not strapped for the paycheck. But the rule of thumb here, and what I've seen my most successful clients kind of doing is, it's a rule of thumb, if you can go and make yourself the first paycheck once you go out into practice, and kind of this rule of 20%. If you can kind of cut off 20% of your gross income up front and just do something other than consume it in your everyday fixed expenses. I choose my words very carefully there. I don't say invest. I don't say pay off debt, because each person is going to be different, and where that money goes is going to change as your life progresses, okay? The goal is to just have 20% of a saving strategy and just not consume it in your fixed expenses. But in terms of retirement plans, there's kind of a retirement 101 or kind of a pecking order I go through, especially during training. The first one, if you're in training and you do have a few extra dollars to save, the first place to look, if your employer has a match, fund it up to the match at least, take advantage of the free money. And then the second, if they don't offer a match, which I know a lot of teaching institutions don't, take advantage of what's called a Roth IRA. A Roth IRA is funded with after-tax dollars. You can put $5,500 up to it a year. And then as that money's invested in that vehicle, it grows tax deferred, so no taxes while it grows. And then in retirement, you can actually pull that money out tax-free. The benefit of starting that when you're young is you're able to save a decent amount of money in there on an after-tax basis when your income's low and you're not paying a lot of taxes as is. And then you have a 20 to 30 year time frame for compounding interest to kind of take over. And then in retirement, what it offers you is options. Tax diversification is definitely something that you should build into your plan, because if we're talking 20 to 30 years down the line, we don't know what taxes are going to be on ordinary income. We don't know capital gains. Now you have a little money invested and taxed at different rates, so you have options and the ability to choose where you withdraw money. The main thing to really get into once you enter practice and actually have that excess income is to first take advantage of your employer-sponsored plans. The 401ks, the 403bs, 457s, they're out there. Basically, what they are, they're pre-tax vehicles. The max you can put up to it currently is $18,000 a year. It lowers your income for that year. So for example, if you're making $118,000 for that year, and you fund your 401k at $18,000 for that year on a pre-tax basis, it lowers your taxable income for that year. So in that scenario, you'd actually be taxed at $100,000 for that year. The money goes in pre-tax, it grows tax deferred, so same growth, no taxes. And then as you retire and decide to withdraw that money, You will be taxed at ordinary income rates based on what our rates are at that time, and then also how much money you would draw out of that on an annual basis. There are some pension plans, kind of 50-50. Some people offer them, some people don't. They're not very common too much anymore. And then if you're looking and you're saying, hey, I kind of want to go into the independent contracting world, maybe some private practice, there are options out there to open up SEP IRAs or solo 401ks, where essentially now you are the employee and the employer. You can actually put these or maximize this on a pre-tax basis up to $53,000. So same example, if you're making $153,000, you put a $53,000 pre-tax in there. Now your taxable income for this year is $100,000. These vehicles are really nice, and why they're really important early on is because most of you, once your income goes up, are probably going to pay more in taxes than you earn this year. So now these are nice tax shelters to essentially lower your taxable income for that year and make the pain not so bad. The sample, kind of starting steps. If you're really thinking about generating this stuff early on before you go out into practice, I kind of went through some of the main ones. Eliminate bad debt, try to build up some emergency reserve, but I understand living in Chicago or wherever you're from, the income that they give you, it's kind of tough. You're kind of going paycheck to paycheck on that side. Just more build the habit and learn how to automate some money out to a different account, whether it's a savings or a money market. It doesn't matter how small, as long as the habit's there. Once the income goes up, the number increases. Implement the proper risk management. You've worked hard to obtain this career, this lifestyle, this income. Make sure to take the proper steps to protect that. The last one, if you got a family or just kind of want to get things in order, create the proper estate planning documents. Wills, trusts, power attorneys, medical directives. In case anything happens to you, there's something in writing to say, this is what I want, this is where I want my assets going, this is how I want the trust set up. Once you're out in practice, maximize those employer-sponsored plans, and then if you have some left over, kind of look into different vehicles to automate the excess savings. Those vehicles can be vastly different based on your goals, but just make sure to speak to someone that can offer all of these options to you and really to make sure you're putting together a plan that's going to help you reach your goals. The last one, I want to just toss this slide in there a little bit. The main common mistakes that I see from people. The first one is the really main one, as it's bolded and underlined, is just really overbuying on your first home. As some of the fellows in here, you probably have some friends that, went out, just purchased their first home. They usher you over and say, hey, come over for my housewarming. And they usher you into the one room that has furniture because, they can't really afford. They're still saving to furnish the rest of the house. That is a house poor. Make sure to keep your house at a rule of thumb of roughly 2 to 2.5 times your family income. And if you have a little bit more debt, maybe you'll be on the two times your family income. If you have no debt, maybe you can stretch that a little bit further. But just make sure to fit a home and not overbuy on that home to make sure you still save or have that 20% savings rule to automate out to your plan for retirement. Spend too much, lack of savings, it's easy. It's easy to go out, get that new higher income. There's no amount of money that can't be spent. I've sat down with people making nothing to a lot, and I've seen people spend a lot. There's just really no amount of money, and when it comes to you, make sure to be dedicated. That's that habit-forming event. Know that you should automate savings without you thinking about it, okay? Because once you start spending all of that money, I've probably an 0 for 100, you like that really nice car. It's hard to say, hey, I know you really like that classy Mercedes, maybe back it down to a Subaru. Doesn't really go over all that well for people. So make sure to monitor and kind of make yourself the first bill that you pay. Delay savings, or just delay seeing someone to kind of get some advice. I see a lot of people, well, I'm not ready yet. Well, a lot of advisors out there will sit down with you, kind of go through the basics, make sure you kind of get these foundational pieces in order, because it doesn't feel like you're doing a lot, but some of those major pitfalls are on some of those foundational pieces, such as debt. Number 4, some of them overlook foundational strategies, don't have a plan for debt, don't protect themselves on the risk management portion. They avoid estate planning, don't automate savings or build the habit to automate savings. Wait for the right time to build your financial strategy. Misunderstand risk associated with investing. Once you start investing a portion of your money, make sure to get educated. Make sure to talk, understand how everything works. and obtain financial education from appropriate sources, okay? It's easy to Google things, now with phones, technology, everything's at our fingertips. Understand a lot of Google articles or the things you see on news. It's going out to the masses. It's very hard to say this makes sense for you or it doesn't make sense for you, especially if you're kind of obtaining that information through things written for the masses. As physicians, you're in a little bit of a different world. You come out, you go through med school, you get all this debt, you go through training, and then, now you're coming out and your income just quadrupled. You're not the norm, so understand to make sure to obtain information based on your world, because the physician world and the programs out there for you are a little bit different. Then assume work-sponsored, retirement plan contributions will be sufficient enough for retirement. 401ks, 403bs typically are not enough to provide financial independence to physicians. Usually you want to max fund those things, take advantage of them, but at a certain point, they're very limited on the amount that you can put in there. So make sure to look into some different vehicles, automate some savings out into some other vehicles to make sure that you can reach your full capacity of savings, to make sure when you're ready to retire, you do not have to see a drop in standard of living. The last thing I really wanted to wrap up with here is just really what to look for in a financial advisor. If you're looking to kind of generate a relationship with an advisor, just some things to consider. Financial firms, they can be either captive versus independent. Understand a captive company, if you go to them, only can sell their products. So if they only can sell their products, guess what the best product is? Versus an independent financial advisor, which really mainly focuses on education first. Here's what's out in the open market. Here's the education towards those products. And now that you know, it's an easier conversation to have and line up products based on your plan to really fit your goals and the needs and kind of the values you have. Does your advisor understand your career? As I mentioned before, your world's a little bit different. It's a little bit different than the 23-year-old that came out of college and just immediately went to work at Comcast, for example. Your world's a little bit different in terms of debt size, later starts, all of a sudden your income balloons out. Just make sure to go to someone that really specializes in your world. Then the last one, is the main thing that with a lot of my clients that come from other advisors, the few things that they always tell me is, when I ask what was wrong with the last relationship is, one, an agenda kind of felt like it was being pushed at them pretty aggressively, and two, they didn't really understand where fees or compensation was coming from. It shouldn't be a hidden point. It's something that should be told to you in the first meeting, on top of maybe tossed in an email or in writing so you have it, because I believe that most people don't have a problem with someone getting compensated for the work they do. They just don't want to feel like the blinds are being pulled over their eyes. So make sure to ask these questions, and if someone's kind of dancing around the topic, shouldn't be danced around, maybe go and check out or kind of interview a few other people. It's something, those are the three things that really should be touched on the first meeting and really gone through. Any questions or anything that come up during the topics? Then if you would like any other information, I am located in Chicago. That's my information up there, cell phone and on top of email. Always feel free to reach out if I can help you with anything or be a resource. But any questions for you guys?
I have a quick question.
Yeah.
So there was concern with the current administration that the public service loan forgiveness was going to be capped.
Yeah.
And with everything that's happened in the last month, do you have any ideas to how that's going to be affected maybe in the future?
Yeah, so there's a few things. I get this question a lot. The cap, it did come out. There was all those talk and capping it was 57,000, but nothing was really passed. And what I always tell people is, can we all agree, I guess, that our government has a typical problem, maybe overpricing social programs, not really doing so well on that, but they're usually pretty good at taking it on the chin. They usually grandfather people into those programs. So if you were in there, and you kind of were making these payments and this is what they said it was, I believe that those people would be grandfathered into the old program. I think the government's going to take it on the chin and say, whoops, we kind of mispriced that one a little bit. But do I think it's going to change going forward? I think it has to. But a little education on, I guess, how those things came about is really directed towards lawyers. In 2007, there was an abundance of lawyers. They come out with very similar debt size, and no one wanted to go in the public sector because when you got that type of debt, no one's trying to live on a lower income. So they came out with these programs to kind of sway people or kind of fill in the public sector for them. So I always joke with people, I'm like, well, if they change it halfway through and it was mainly directed at lawyers, I wouldn't really want to be on the other end of that line of when they change it. But do I see it changing in the future? I think it has to. I don't think they expected this many people, especially with $200,000 of debt, taking advantage of it. But do I think the people that are already in it are going to be grandfathered? Yes. Well, if anyone wants to use me as a resource, that's my information.